Welcome to our video about individual retirement accounts. My name is Andrew Bixel, and I'm the Director of Endowed and Planned Giving at Grand Valley State University. In my role, I connect with alumni and community members to hear the impact they want to have on the university, whether this is by giving a gift now or putting Grand Valley in their state. Today, I'm joined by Tim Sullivan, a 1998 MBA alumnus who is a financial advisor with over 20 years of experience in the field and works at Growtrust Partners. He focuses on long-term financial management, retirement income strategies, and growing and preserving clients' assets. In his time outside of the office, Tim is an assistant varsity baseball coach at East Grand Rapids High School. Tim played college baseball at Aquinas College and was inducted into their Hall of Fame in 2015. In addition to this, Tim serves on Grand Valley's advisory committee. Tim, thank you for joining me to answer some questions around individual retirement accounts, IRAs. While we are sharing this knowledge, this is not intended as legal or tax advice. For such advice, please consult an attorney or your tax advisor. We also have the following disclaimer from Growtrust Partners. We're going to leave this on the screen for a couple of seconds so you have the opportunity to read and review it. Great. Well, Tim, again, thanks for joining us today and being part of this conversation. The first question we have is, can you just give us a brief overview of an IRA?
Sure. I'm going to focus on two of the most common, the traditional IRA and the Roth IRA. So IRA stands for Individual Retirement Account. Contributions are limited to $6,000 per year. If you're 50 and older, the limit is $7,000 per year. So with the traditional IRA, contributions are made and the amount contributed can be deducted from taxes in that tax year. The account remains tax deferred until funds are distributed to the owner in retirement. Accounts cannot be accessed without penalty until age 59 and a half. So with the Roth IRA, contributions are made after tax. Any earnings in the account are tax-free. Account contributions can be accessed without penalty prior to 59 and a half, although earnings cannot be accessed until 59 and a half or older. So both have their tax advantages, but are recognized at different times.
Gotcha. That's extremely helpful to know, I think, especially too, given the current situation or pandemic that we're living through. Obviously, one's employment status or family situation may have changed. If this has happened, is a person still able to access one's IRA account earlier than the required age? And then, what's the possible impact?
Yes, so the CARES Act, which was signed into law this spring, allows individuals affected by the pandemic to take emergency withdrawals of up to $100,000 from their retirement plans. Savers under 59 and a half can now withdraw funds from their 401k and 403b accounts without the usual 10% early withdrawal penalty.
Wow.
This also applies to individual retirement accounts or IRAs. Individuals affected by the pandemic have until December 31st, 2020 to take up to $100,000 out of their retirement savings. Individuals can pay this money back to their account within 3 years. If not paid back to the account, distributions are taxable and will incur the 10% penalty.
Yeah, that's, I just think especially with so much going on and the CARES Act being passed, really appreciate you just sharing that knowledge and tidbit. Because I think, everyone has been impacted in some sort of way due to the pandemic. So it's good to know there are options. I think that on the flip side, obviously, a non-pandemic year, normalcy of some sort, are individuals, I guess, able to give from an IRA? And if so, what are those requirements?
Sure. So yes, individuals can contribute directly from an IRA to a charitable organization through what is called a qualified charitable distribution, or QCD. So it's a non-deductible contribution directly transferred from your IRA to a charitable organization of your choice. The amounts distributed as a QCD can be counted towards satisfying your required minimum distribution up to $100,000 a year. You must be at least 70.5 years old at the time a QCD is requested. So it's an excellent way to reduce taxable income while still giving to a charitable organization, even if you claim the standard deduction on your taxes.
Wow. That's great, Tim. And I think a lot of people sometimes, when you get to that age, you're thinking, oh, I need to take this. I'm not sure what to do. Having this as another option is just hugely helpful. And then our last question that I have is, do you have a last piece of advice or information you'd like to share about IRAs?
Sure. If there's one thing that I would recommend, regardless of age, would be to get your financial house in order. So pay attention to and document your spending habits, review your financial plan and your accounts regularly with an advisor. And if you do not have a system, I strongly suggest to find a way to organize and maintain important documents, including health and medical directives, banking and investments, insurance, estate planning. In the event something were to happen to you, having these records organized and easily accessible is key to your beneficiaries. So getting your financial house in order and not putting it on the back burner is very important to the retirement planning process.
That's a really good piece of advice. I think especially as you want to make sure you have everything together so your family or your friends, whoever is sort of with you, can make sure they have all of that in one location. So great piece. So, well, Tim, thank you so much for giving your time to share with us your expertise. We appreciate your knowledge and insight. For those of you watching, thank you for tuning in. If you have any questions, please let us know. Our contact information is below. Thanks and enjoy your day.
Thank you, Andrew. My pleasure.